Thank you for getting up so early to talk to us. What are you looking for this trade print?
We're looking for slightly resilient, more or less resilient exports and slightly worsened imports on a sequential base. And the reason for that is that, some of the initial data that we're seeing out of Korea, out of some of the initial signals we're seeing, shipments and cargo traffic does suggest that export momentum has been quite strong. And especially in the segments of IT, semiconductors, those seem to be quite resilient as well. So I think today's numbers will show that exports continue to be a good driver of the China's cyclical growth story. Imports, on the other hand, might weaken a little bit. We think that really is a function of the fact that demand is tapering off from quite a high Q1. So I think we're looking at overall quite an imbalanced story today.
All right, so Louise, exports seem to be the best thing China's economy's got going for it right now, and I suppose a more competitive Chinese currency, the renminbi, helps. You see further pressure on the renminbi going forward. We had a guest a couple of days ago, also very bearish on the CNY and calling for 8.2 on the exchange rate. My question to you is, exports are already doing pretty well, thank you very much, for China. Does it need an even more competitive currency, or is there a floor to this beyond which authorities don't want to see the CNY go? Because if nothing else, it also expresses the view that local money continues to leave the country.
Yes, I think the considerations around currency management in China has increasingly shifted towards the capital flight risk. Certainly our baseline view is not for an 8.2, but we do expect that going forward, the PBOC should be able to tolerate more currency weakness. And the reason for that is really that, not just the competitiveness of exports being quite a key driver for the recovery, but also the fact that, you do have a pretty low inflation environment in China. So any kind of imported inflationary pressures from a weak currency is not going to be very meaningful. So that's good news. Having said that, we have seen that the RMB has continued to be under pretty meaningful downward pressures in recent weeks. So it really is a function of how well PBOC can manage that fix in order to push back on depreciation fears. Now, 8.2 is quite a bearish view for me. I do think that that is perhaps the kind of range we'll be looking at if indeed, tariff risks start to materialize, which, in our case, needs to be quite managed.
Okay, so it's a polite way of saying come November, if it's 60% or higher tariffs from a new government in the U.S., then maybe 8.2.
That could be possible, yes. That could be a way there.